In my opinion, every trader should know how to differentiate a breakout from a false breakout. Whether you are an intraday trader, BTST trader, swing trader, or investor, it doesn't matter. When you have the ability to differentiate a breakout from a false breakout, you will be able to make a best entry and best exit in any trade. So let me explain in detail. So there are two types of money in the market. One is smart money, another one is dumb money. So smart money will decide how the price moves in which direction and how much with how much magnitude. Whereas dumb money try to push the price, but it always fails to make money for the people actually. So let's take this as an example. Just observe this chart very carefully. So from here the price started going upside, right? So which means smart money is in upside. Price comes back. See, whenever price came to this level, you just look at this big candle with a big buying wick. So along with a good volume. So what this indicates is smart money intention is very clear to accumulate this particular stock as much as possible, right? And once again the price came back. Here also they pushed the price upside, but here once again see the big buying wick. Okay, so this comes at a false breakout of this. Okay, if you draw a trend line like this, so this is a false breakout, a big pin bar, right, along with a big volume spike. So what this indicates and confirms is smart money is still anticipating the price. This is available at a very discounted price, and hence there is a high possibility of price going on the upside. Once again price came back to the same level. See here there is a big bullish engulfing, right? There are two candlestick patterns are very powerful. One is Marubozu, bullish Marubozu or bearish Marubozu. Another one is bullish engulfing or bearish engulfing. So in this case here the trend is clearly upside. Here the smart money participation is confirmed with a big candle with a big buying wick. Once again smart money participated and it prevented the fall. Once again it came and there is a bullish engulfing and price came here. Look at the consolidation. Price consolidated for a more number of time before this trend line, right? So this is a proper resistance trend line and price now broke the resistance trend line along with a good volume. Now what is the action of smart money? So smart money is thinking it is available at a discounted price and it is accumulating this stock whenever there is a good opportunity, right? So now the smart money is pushing the price upside, right? Now if you are a dumb money, then only you'll think to take a short trade at this point of time. But if you are a real smart money, or if you can understand the action of smart money, it makes sense to follow the plan of smart money, right? But that comes with a knowledge of the differentiation of breakout and false breakout. If you can't differentiate a breakout from a false breakout, you will take many number of false trades only to lose money. That is why the knowledge and identification of breakout from false breakout is very important. If you look at the result now, there is no doubt, right? Price rallied on the upside. So this is also called as price acceptance in market profile world. Okay. So now one more example, smart money rejection. See here, the price is in a sideways trend and whenever the price rallies to this particular level, there will be a big volume spike. So what this indicates is, smart money is thinking this, the value of this particular stock will not go above this level, at least in recent time. Okay, hence whenever the price bounces, they are closing it, they are shorting it with a big volume spike. And here the same thing, right? There is a big volume spike, price came downside. Now one more simple example. See here there is a big bullish engulfing, right, along with a volume spike. Price came here. See here, whenever the low came, there is a big volume spike. But whenever the price goes to high, there is no shorting high volume spike, right? But whenever the price come to the lower level, there is a volume spike along with a big pin bar, big bullish engulfing, right? There is a look at the gaps actually, along with the volume spike. So now there is a clear resistance trend line, and price broke the resistance trend line along with the volume spike, right? Now what is the smart money plan? So smart money is thinking the price will go upside, right? You can look at the result. Okay. So in this example, okay, in this video, I will be explaining a positional breakout trading system. One can use the same logic even for intraday trading as well. But I will be explaining a simple positional breakout trading system. At the same time, I have explained both the positional breakout trading system, intraday trading breakout system, and many other breakout forms in my recent book, How to Make Money with Breakout Trading 2.0, which is published with India's leading publisher, Manjul Publication. You can also check it out. I have given the link in the description actually. Now, this positional breakout trading system consists of three important segments. So one is drawing proper trend lines. Second one is identification of real breakout. Third one is trade execution. Okay. So first I will explain drawing the proper trend lines. When you are trying to draw a trend line or when you are trying to pick a stock to trade, you should avoid all the stocks which don't have smooth price action. See, for example, if you consider this price action is not really smooth, right? Because it contains many buying wicks and many selling wicks. This might go upside, but there is a high possibility of triggering your enterprise and going back, or it triggering your stop loss level and then going upside. So there is a high possibility of those kind of false trades. Hence I always suggest, whenever you see the lot of wicks, okay, please avoid it. And second one is whenever it shows too many gaps also. See here, there is big gap, there are many gaps, because the same thing happen with gaps also, because it might sometimes you might lose more than your stop loss, because it can open with a big gap down only to lose more money, or it can open with a big gap up and you will not be able to manage the trade, take the trade. So this kind of example, please avoid it. This is one more example. This is clearly in operator stock in most cases, because there is no activity on some trading days. So it indicates retail people are not participating. In fact, people are not participating. So there is a high risk of operator stock. So whenever you see these dotted lines, please avoid those kind of sticks. Three stocks, whenever there is a big selling wick, big buying wick, or big gap up, big gaps, and whenever you see there is no operation on many trading days, please avoid those kind of stocks. So now, what is trend line? A trend line is a straight line drawn on a chart connecting two or more price peaks, that is swing lows or swing highs, which reveals the trend of a stock, support and resistance point, and it helps us to take excellent trade opportunities. Okay. So now you should follow three references to draw a trend line. So price peaks, the slope of the trend line, the price should respect the trend line. Okay. So in this case, price peaks. See, I have connected first swing low, second swing low, third swing low. You should connect minimum 2 to 3 peaks with swing lows or swing highs to consider it as a valid trend line. Now, the earlier one has a support trend line. This is a support trend line. The next one is a resistance trend line, right? Again, I have connected 1, 2, 3, 4. Even if you ignore this, I have connected 4 peaks actually. So this is a valid resistance trend line. You should draw a trend line in such a way that you should be able to connect more number of peaks. I have made a detailed video on drawing resistance trend line. You can also watch that video. I have given link in the description. Now, whenever you draw a trend line by connecting more number of peaks, so there is a high, this becomes a powerful trend line, and there is a high possibility of that particular trend line acting as a support trend line or resistance trend line. The second one is slope actually. So whenever you draw a trend line, ensure it will not cross 45 degree angle from an imaginary horizontal line. For example, if you draw an horizontal line like this, if you look at the angle, it is more than 45 degree, right? So don't draw trend line with this higher slope actually, because that doesn't indicate the health of a healthy trend. So healthy trend always comes with a less than 45 degree angle. And you should also ensure the price should respect the trend line whenever you draw it. See, if you observe this trend line very carefully, I connected here, price exactly came back from here, right? Price exactly came back from here, exactly came back from here, exactly. See, so in this way, price should respect the trend line. Here, for example, I have also draw a trend line, but if you look at here, the price has not respected the trend line. Compared to the previous trend line, the importance, the power of this trend line is less actually. Let me explain in detail. For example, let's say you're working in a company, you are the boss, you have two managers, John and David. Both John and David has same educational qualification, same number of years of experience, and they work, assume they work 5 years in your company at a time. Now you need to give promotion to one person. So to whom you will give, John or David? So I want to add one more thing. There are so many employees, for example, two employees like John, and there are many employees who like David. So in this case, to whom you will give the promotion? So if you are a really sensible person, you go with a David, right? Because many people likes David, and there is a high possibility of he's having a smooth relationship with the employees going forward. So the same logic will apply to the trend line also. Whenever there is a trend line which is connected by more number of peaks, the importance of this particular resistance trend line increases actually. And whenever you spot like this, it is like not respecting, the price has not respected the trend line, and there is a high, the importance of this particular trend line decreases actually. So now these are some of the simple trend line examples. See, I have connected 1, 2, 3, 4, 5 peaks actually. Okay. This is one more example. Resistance trend line 1, 2, 3, 4, close to 5 peaks. So this is one more example. I've drawn a trend line like this: 1, 2, 3, 4, 5 peaks. Okay. So to put it in simple words, so because this is a BTST, this is a positional breakout trading system, you need to look at daily charts with 6 months to 1 year duration to draw a trend line. So when we don't consider charts that don't have smooth price action actually, and whenever a trend line connects more number of peaks, it will become a dominant trend line, and the break of such trend line gives a very big moves. Always ensure the slope of the trend line should not exceed 45 degrees, and the price should respect the trend line at all the peak points. Always remember, drawing the trend line is an art and it is not subjective. So there is no need to debate about drawing a trend line with anyone. Now, how to decide a genuine breakout? That's the most important lesson of this particular video. See, here there is a trend line. The price crossed the trend line. So the traditional definition of breakout says if the price closes above the resistance trend line, it is a breakout. So in this case, the price has closed above the resistance trend line with a big candle. Do you think, along with a big volume spike, do you think this is a good breakout, real breakout? It is not, right? It came down actually. Now one more example. See, again there is a resistance trend line. Price closed above the trend line with a decent volume spike. Do you think this is a genuine breakout? Not actually. It went downside, right? So one more example. There is a valid resistance trend line, breakout or false breakout. There is a volume spike. It is a false breakout, right? Now Then how do we decide it is a real breakout? You should always look at four things to differentiate a breakout from a false breakout. So number one is a breakout candle, a big breakout candle. Number second is quick time. Number third is absence of opposite party response. Number fourth is good volume. So these four concepts are applicable for positional breakout trading. You don't have to consider good volume if you are looking for intraday breakout level, because many times you may not be able to judge or assess what is good volume and what is average volume in intraday level, which means 50-minute chart or 10-minute chart or 5-minute chart. Okay, so let me explain these concepts in detail. A big breakout candle means, see, this is a breakout candle, right? This is a, you should have a big breakout candle like this, which is breaking the resistance trend line actually. See, this is one more example. So there is a resistance trend line, price is breaking with a big resistance trend line, right? So this big breakout candle is essential for us actually. See, quick time, which is also related to big breakout candle, but I'll explain this concept clearly. See, there is a resistance trend line. Price started trading above the resistance trend line with a small candles, right? See, big breakout candle indicates the power of smart money, whereas small candles after the breakout indicates the absence of the participation of the smart money, isn't it? Let me repeat once again. A big breakout candle indicates smart money is participating in the game and they are accumulating in the game, whereas small candles after the breakout indicates the lack of participation of big money, isn't it? See, again, the small candles, it's there after the breakout. That is the second point. And the third point is absence of opposite party response, which means absence of selling wick. If you notice this particular candle, the selling wick is almost nil, negligible, right? So whenever the breakout happens, it provides an opportunity, it advertises an opportunity for both the buyers and sellers. If the sellers are really strong, they should push the price downside, right? So their participation results in a selling wick, big selling wick. If the selling wick is absent or very small, what it indicates is buyers are strong enough to accumulate all the position, all the selling orders, and there is no selling wick actually. So the third parameter is absence of opposite party response or absence of selling wick. See here, the selling wick is very small. So this confirms buyers are really strong at this level and they are accumulating all the selling position. Now many people ask how much selling is acceptable. Generally, I would say you go with a normal blind eye rule, or normal with eye rule. But if you are a really beginner, ensure that the selling wick is less than 20% of the entire candle. See, for example, this is the overall range of the breakout candle. Assume this is the overall range of the breakout candle. 100 is the low, 110 is the high, 18 is the close. So in this case, when you consider 18 close, it is 20% of the overall body, right? So to consider selling wick is less, always ensure this wick is less than 20% of the entire body. So in this case, close should be 108 or above. Only in this case, the selling wick becomes less than 20%, right? So in this case, it is acceptable. Now, good volume. Whenever the price shows the breakout, along with the number one big breakout candle, absence of opposite party response, then good volume is very added bonus actually. Whenever you see a good volume, it also confirms the price is going on the upside. Okay, so look for these four parameters actually. See, this is one more example. Here also there is a resistance trend line. Price is trying to it displayed the breakout, there is a good volume spike, right? So this confirms the logic actually. This is an ideal breakout actually. See here, there is a support trend line, there is a resistance trend line. Number one, big candle, yes. Number two, quick time, yes, it moved in quick time, it moved in only one candle. Number three, absence of selling week, yes, there is absence of selling. And number four, good volume. So this is an ideal scenario. So one can apply the same logic at intraday trading also, but you don't have to consider the volume, because if you are a beginner or even intermediate level trader, you will not be able to guess or judge which is good volume, which is average volume at intraday level. Once again, I've explained all this even intraday level breakout in my book, How to Make Money with Breakout Trading 2.0. You can check it out. Anyway, link is in the description. Now this is one more example. See here, there is a valid resistance trend line. Price broke the resistance trend line. Number one, big candle. Yes, there is a big candle. Quick time. Yes, it moved in a quick time. Absence of selling week. Yes, there is absence of selling week. Big volume. Yes, there is a big volume, right? You should look for these four parameters to differentiate a breakout from a false breakout. One more example, there is a valid proper resistance trend line. There is a big candle, big breakout candle. Number one, big breakout candle, yes. Number two, it moved in a quick time, yes. Number three, absence of selling week, obviously yes, there is a less selling week. Number four, big volume, there is a huge volume spike, right? So this it satisfies all the four parameters, hence there is a high possibility of breakout or price rallying in this direction upside. Okay, so to put it in a summary, it is essential to filter the real breakouts to get success. The first quality of real breakout is that breakout should happen with a big candle. The second quality is breakout should come in a quick time on daily charts. It should display breakout criteria in one day. The third quality is the absence of opposite party response, which is nothing but absence of selling. The fourth quality is the breakout candle should receive a good reasonable amount of volume. So this is the summary. A trading system should define entry, stop loss and exit levels very clearly. See, whenever the price is in a downtrend, when you take a trade, you should look for the topmost resistance level or the starting point of the resistance trend line as your target. Okay, your entry should come above the high of the breakout candle. Your stop loss should be below the low of the breakout candle. This should be your target. Or you can also look for 1:2 risk reward trade, or when you see 1:2 risk reward here, then only you can plan to take the trade. Otherwise you can always skip the particular stock. So this is entry, stop loss, exit in a sideways trend. See, in this case, the particular stock is in a sideways mode. You got the trade here. Your entry should come above the high of the breakout candle. Stop loss should be below the low of the breakout candle. So in that case, you can target this length actually. Okay, this width, you can target this width on the upside whenever the price is in a sideways mode. And whenever the price hits the all-time high or in a big uptrend, it is very difficult to come up with a target point, because nobody can know how it will make the top. So in that case, what you can do is, again in this case also, entry comes above the high of the breakout candle, stop loss should be below the low of the breakout candle, but one can exit 50 to 75% of their position at 1:2 risk reward, and you can trial the remaining position below the low of every swing. You can also do that. See, what separates the experts from retail traders is their ability to manage the exits actually. I have seen many people that take very good entry. Most of the beginners, whether even intermediate level traders, most traders take very good entry, but where they struggle is in exit actually. So that's why exit is very important. See, the trial SL and exit is very important. In this case, let's see, there is a resistance trend line, big breakout candle, we have it, quick time it came, absence of selling case, good volume is. But let's assume after after the breakout candle, let's say next day you've taken a trade, it displayed a candle like this. So if you remember the third point I said, the absence of selling week, absence of opposite party response is necessary to identify to classify it as a real breakout. So after taking the trade, whenever you see an opposite party response, it makes sense to trial the stop loss from the original stop loss to the low of the this candle, the bearish candle or the opposite party response candle. I'll repeat once again, friends. Whenever you identify or notice a selling day, selling candle, selling day, immediately after taking the trade, it doesn't make any sense to hold your original stop loss. You can trial your stop loss to the low of the selling candle. So in this way, it automatically this trade will become a break-even trade or a small loss trade or a small profitable trade. But you should remember one thing: many people will lose maximum portion of their capital with few trades, but nobody will lose the entire capital over a period of 100 trades. So whenever you start to minimize the losses, automatically whenever you get this kind of trades, it will become a break even trades almost, or small loss trades. But whenever you get one or two profitable trades, automatically you make money, right? So I always suggest, whenever you see a selling thing, it makes sense to trial your stop loss. So in this case, see, price came back and it went downside, right? If you are holding this particular stock with the original stop loss, you would have taken a loss, right? So in this case, by trialing stop loss, your trade turned as a break-even trade instead of a losing trade, right? See, this is one more example. It satisfies all the criteria: big candle, yes; quick time, yes; absence of selling week, yes; good volume, yes. Now let's say you will take a trade above this and the stop loss is below this. Now there is a small doji. So in my opinion, price should rally quickly. The small doji also indicates the lack of participation of smart money. So once again, you can trial your stop loss from this to the low of this doji. So in this case, if the price goes upside, you will make profit, but if the price comes back, you exit the trade with a small loss. Now it reduces your loss by 70 to 80%, right? So in this case, see, price went upside without taking the stop loss. So in this case, you made profits, but if the price came back, you would have avoided 70 to 80% of the loss, right? One more example, there is a resistance trend line, price candle is big, quick time, yes; absence of selling week, yes; good volume. So in this case, there is a small selling candle. You need to trial your stop loss from the low of this breakout candle to the low of this. So in this case, price hit your stop loss and then it went upside. I'm taking this example because sometimes we do face these kind of experiences in market, but because of these experiences, we should not change the rules. We should not amend the rules. Okay. I've seen many people, whenever they experience this kind of trades, they skip to trial their stop losses from year to year for the further trades and only to lose money. Okay. So please don't do that. Whenever you see a smelling candle, you can trial your stop loss price. You might lose an opportunity to make money with these kind of trades, but these kind of trades are very less, and the winning trades always make money for you. So the partial exit scenario is, I have seen many traders, they don't have the conviction or clarity to hold the trade. So those kind of traders, what they can do is, or some traders, they want to carry the position as much as possible. Those kind of traders, they can initially exit at target, at least 50% or 75% at target, and carry the remaining position. See, for example, here, this is the entry, this is the stop loss, this will be the target, right? Because the price is in a downtrend, in the original target you can exit 50% or 75% of the position. You can carry the remaining position because the remaining position also makes profit. And if you get one this kind of trade, the profit from 25% of the position in this trade has the ability to absorb the loss of maybe another 10-20 trades actually. So that's why this partial exit is also very important. So this is one more example. It is in a downtrend. This will becomes your target. You can exit 50 to 75% of the position at target. See, if you have carried the profit for the 25, I mean the profit is close to 10 times of your original risk actually. Okay. So this is one more example. See here, the price is in an uptrend. It went upside. It rallied like anything. It moved close to 12 times of the original risk. Okay. So money management. So always deploy only 10% of your capital per trade. Why? Because let's say if you have 1 lakh rupees, invest 10,000 rupees per trade, because this is a positional breakout. This rule will change if you are an intraday trader, because in intraday trading you should not lose more than 1% or 2% of the capital per trade. Let's say if you have 1 lakh rupees, if the trade comes back and hits your stop loss, means you should not lose more than 2000 rupees per trade actually. And again, in positional breakout trading system, don't deploy more than 50% of capital at any time, because it indicates only 5 active trades. Why? Because the price moves in uptrend, sideways trend and downtrend. Whenever you deploy all the capital, until you learn, actually until you get a grip, don't deploy more than 50% of the capital. Why? Because you may not be able to exit at the proper, because it might result in a selling candle. You might not trial your stop loss, and you might hold the trade for all the stocks only to lose more percentage of the capital. So I would suggest, until you get a grip on this particular system, deploy less 50% of your capital. This is for intraday trading. I always suggest less risk, less than 2% of your capital on every trade. Friends, I hope this explanation is really helpful. If yes, you can like the content, you can subscribe to my channel, and you can also share this video with your friends so that they will get the real trading knowledge. You can also check my book Breakout, How to Make Money with Breakout Trading 2.0, which is published with India's leading publisher Manjul Publication. I've given the link in the description. So we will see you in the next video with another useful content. Until then, thank you. See you. Bye bye.